when you come out, you have to build context constantly. You got to think about what the story is, and by default, always run your head through what the story is telling you, as if you're reading a book. And if you think about trading as a book, it would be a detective book, right? A mystery. And every chapter is giving you clues as to who might have done it and trying to also distract you and make you think somebody else did it and play games. And you have to think that the market is trying to market to you to get you to buy and sell. It's trying to distract you. And you always play on the emotions of greed, or it plays on the emotions of greed. There's always people greedy. So if you take a look at this move, and this is the story and this is the context, what did a market do before it did this? And this is sold off very quickly and seemingly out of nowhere. What was the story? The story was clear. Did it rally? Was it breaking? Was it going sideways? It was clearly rallying going into this sell-off. And this chart over here is just taking a helicopter view of price, and this is here putting under the microscope. And so we were rallying. Did it have a target that you think was popular? And the answer would be yes. There's white lines of VWAP, and a lot of people use that as a target to exit, but a lot of people aren't that smart about using a target, and they actually use the exact price to get out of their trade. You have to give it a little bit of a cushion to get out, to give yourself a better chance to get out. Because the worst thing that happens if you're long from down here and you get yourself a nice 5-6 point head start and you are offering up there to get out of that 4 or 5 point winner, and it comes just underneath your price, you don't get filled, and it does that. Everybody watching this video or watching this live has had that happen to them if they've traded more than 5 days. And it's a crappy feeling. You want to minimize that feeling as much as possible. So you got to give it a cushion. That's number one. But secondly, even if you're not into a position, you have to pretend like you are. And how would the people who are in that position feel to give you a sense of what's going to happen next? Because we're in the predictive business. And that means if you get a sell or a move downside like this, and again, out of nowhere, where it's just, walking up and you have someone with their hands in their pocket, whistling, walking down the street, and then all of a sudden a plane crashes in front of them. That's this. And everything was calm, and now it's kind of not, relatively speaking. You always know there are longs and shorts in the market. And so as the market goes up like it does, you have longs that had money into a trade, okay, from down here, that probably do not feel too good when this comes out of nowhere. You know what I'm saying? Shorts aren't pissed off when this happens because they want price to go lower. People who want to buy it aren't pissed off. They're happy because price went lower. But people who want to sell it, or sellers, would be pissed because they had a chance right here to sell it, and then right here, they don't have that chance. That opportunity is gone. So who are sellers? We know sellers are people who are already long, right? You should know that. If you don't, go become a plumber. So after you're long, you become a seller. So the longs that are long are probably still, if they're still long, obviously, they're pissed when this happens. Why would they be happy? If they're happy, they need their head examined. So right in here, and this is what I drew at the time, there are pissed off in this area, pissed off offers. Offers is another word for sellers, right? When you sell it, you're offering to get out. And pissed off offers in this area. People who wished when it's down here that they would have got out when it was up there. But too bad, you can't. So it creates a tougher, it's tougher for price to do this and then come all the way back up too soon. It's generally has to, if it's going to go back up, it's got to go down and then come back up. But this is not a great place to try to look for a long down in here because you got pissed off longs above you. Pissed off offers, rather, above you, coming from pissed off longs. Why are they pissed off, Anthony? Because moments ago, they could have sold it much higher and they waited and probably had a lot of target offers up there, it came close, boom. How would you feel? You always could accurately more accurately predict how somebody else feels if you could put yourself in that position and then think about how you would feel. That's the best way to read other people. And that's what reading order flow and reading these markets are, is you're reading the psychology and positions of other people. How would you feel if you were in the same situation? And if you accurately know how you would feel, then you would know how the other people feel who are in fact long as you read the story. And so you get pissed off offers based on what I just walked you through. If you watch enough of these highlight videos on YouTube, there's always a through line that's common, and that is what are longs after they're long, what are shorts after they're short. As far as after you're short, you now have to buy it to cover. Cover means flatten. And after you're long, you now have to sell it to cover or exit. So this is opposite conventional wisdom, and you better get used to opposite of conventional wisdom if you're in this business, because those are the principles, those are the advantages, those are the tools that will end up working. You want to be always on the side of conventional wisdom in trading. You will be with the herd and you will go off the cliff with the herd, and you will be in rooms that are locked when there's a fire.